What is an alternative investment fund? And how can you use it? That's what we're going to talk about in this video today, is what you can actually do to actually profit from doing an alternative investment fund and what kinds that are actually available for you. All right, so many times, I'll tell you, as a financial advisor, I was never told what an alternative investment fund was. I knew about mutual funds, but what's this alternative investment fund? Doesn't that sound risky to you? It might sound risky, but I'll tell you, in some ways, you might be able to make more money and do it more safely depending on what that fund is. And I'm going to go through the different types of what that is so that you can actually know how you can not just make more money, but actually have more passive income that might even allow you to retire decades earlier. So be sure to hang in for that. Okay, so what is an alternative investment fund? Now, there could be a lot of varying definitions of this. I'll just give it to you simply what I say it is. And you could debate me whether or not. By the way, comment on my video, debate me all you want. We love it because it gets more people to watch our videos. So if you hate my video, please don't like it, and please comment and tell me all the things you hate about it. Thanks. But here's what I say an alternative investment fund is. An alternative investment fund is anything that's outside the mainstream Wall Street fund. Wall Street funds are typically based on stocks or bonds, based on things like, like your typical Teslas and everything else. That might even be based on an index. Those are the mainstream Wall Street funds. Alternative investment funds, also known as Main Street funds, they are in anything else. Right? They could be in anything. They could be in real estate. They could be in commodities. They could actually be in businesses. Alternative investment fund is basically anything in that other category that's not offered on Wall Street. And I'll tell you, as a financial advisor, I didn't even know this world existed. Yes, I knew you could buy gold and silver. Yes, I knew there was like oil investments and whatnot. I knew there's businesses out there, but I thought, well, why buy businesses when you could buy stocks? Which was ironic because I was a financial advisor who owned a business. I owned my own practice, and yet I'm like, no, invest in other people's businesses, right? But there are so many different ways. This is what hedge funds do. Many people say, I want to be somebody that has a hedge fund. Well, most time you have to be a multi-decamillionaire to have access to those people that actually manage your fund and do a hedge fund where they will actually buy these alternative investments. Here's the good news. You don't have to have millions of dollars to have your money in an alternative investment fund. But there are some key things that you might have to have in place. First and foremost, there are alternative investment funds that you might be able to fund for as little as $1,000. Now, one of the things you'll find in most alternative investments is that you're supposed to be what's called an accredited investor. An accredited investor means that you qualify one of two ways. One, for the last 2 tax years, you've made at least $200,000 filing single, or $300,000 a year as a married couple. Or 2, you have a net worth of at least $1 million, not including your own home equity. Home equity doesn't count, they take it out. But everything else, if you have at least $1 million net worth when you take out your home, there you can qualify as what's called an accredited investor. What is that exactly? Well, the government's trying to basically make it harder for you to get certain deals unless you have a certain amount of money, because for whatever reason, they think if you have more money, you're smarter. Now, I've learned from real experience, and I know many people would agree that are actually accredited investors, just because they have no more money doesn't mean they know more about investing, right? But that's what the government was trying to do to try to create some sort of bar for people to get in. Now, if you're an accredited investor, pretty much the sky's the limit. There's almost a whole open gamut depending on the situation, because a lot of these funds out there, even an alternative investment fund, which is one thing, you might have syndications, which are not an alternative, like not just a fund, but they might be an actual deal you can get. Either way, you might have to put in $25,000, $50,000, $100,000, maybe $250,000 minimum just to get into those deals. So my advice is, if you don't have at least $150,000, don't even worry about this. Plus, you probably wouldn't qualify as an accredited investor anyways, most likely. But there are some non-accredited investments that are out there. They're just much harder to find. Fortunately for a lot of our clients, we actually have some of those contacts with good proven track records, and you can have as little as $1,000 invested in them and start making money on them. Now, these alternative investment funds, again, they could be structured all kinds of ways. They could be in an individual project. It could be an apartment building. It could be a self-storage unit. Now, I wouldn't call this a fund per se, right? When I talk about alternative funds, I don't count these ones. These syndications that are specific projects, I don't count these. A fund I see as something that has multiple projects inside of it. They might have rentals. It could be single-family homes mixed with some apartment buildings, all combined together to create a fund. They might also be something where they have multiple apartment projects, or maybe it's commercial. Maybe they have some apartment buildings. They might have some office buildings, a space, and maybe some warehouses and all kinds of stuff. It might have a certain theme to it or a certain place that they invest in, and then it spreads your risk among different projects that you're kind of a part of, but a very small partner in. Again, when you put your money into those funds, you're either, one, getting paid a fixed interest rate for loaning them the money, or 2, you're actually getting paid any profits that come out of it. Now, there's pros and cons to both, I'll tell you that much. Sometimes people want all the profits, but it might mean that you might not make as much money. It might mean that you might be making little to nothing in certain quarters, because usually they pay you quarterly, or it might mean you might be making double-digit returns. It can sway and go back and forth depending on what they're invested in, what happens. Now in those funds, what's happening in the meantime, they might be buying and selling those projects. Sometimes if they make a really good killing on the sale, that could also mean that you get paid more. But it doesn't really create a lot of consistency. They might have some funds where they might say, we'll pay you a minimum of this, maybe like 6%, 8%, whatever it might be, but then they'll pay you any profits on top of it. So they might have a blended between a fixed interest rate versus the profits too, right? So you get a little bit of floor, but you get a little bit of upside potential as well. But on the other ones, they might just say, you know what? You're going to be a debtor in my fund. You're going to loan me money into this fund, and then I'm going to pay you a fixed interest rate. Now they might vary depending on what amounts of money you put in, the time frames you have it in there for, because some of these funds might say, hey, you have a 90-day option. You can literally have this money come back to you in 3 months. Some might be like 1 year, 3 years, 5 years, whatever it might be. Usually, the longer the term, just like a CD, the more they pay you. But the nice thing is, of course, that as you have your money there, that can get reinvested. So even if it's like a 1-year term, you can keep renewing that term. And so usually the more money you put in, the longer the terms, the more they pay you interest-wise. A lot of these might pay, like I said, 7, 8, 9, 10%, some of them even higher. I have one particular contact in our group that some of our clients will invest with, where if you have at least $250,000, they'll pay you 13% a year, or about 1.1% per month on your money. So if you put that $100,000 in there with 13% and they're paying you out monthly, what happens is that now that $100,000 is kicking off just under $1,100 a month, which I don't know about you, but that's pretty dang good. Considering that if I had $100,000 with a financial advisor, they're going to tell me don't pull out more than $3,000 a year, let alone definitely not $1,100 a month. So there's a lot of cool options you could do. Sometimes they'll even pay you more. If there's specific projects or certain things that go on, they might say, hey, I'll pay you a higher amount. I did lending on my money where I got 15%. I had an offer just recently from one of my friends that he said, I need $1 million right away. If I can even get it between a few of your clients, I'll pay them 18% a year, or 1.5% a month. Do the math. Pretty awesome. Needless to say, they filled up and they got their money in even before I had a chance to put my money in. I was on vacation. By the time I came back, it was done. Like, the opportunity was gone. So I'm not saying you should go chase returns, but it's pretty awesome. It's pretty nice, right? So these alternative investment funds, the nice thing is you can be diversified. Again, even though you're diversified, it could mean that also that you have some safety, but it could also mean that things are kind of vanilla too, because if some of those projects don't go well, it could also affect the returns. You may not be able to count on certain returns coming in. Just so you know, a little bonus here, who gets paid back first if something goes wrong? The debt fund will pay you back first before the people that have equity ownership. See, if you have the equity where you get the upside potential, you're actually lower on the pecking order. Because remember, just like when you sell off an investment property or even you sell off your own home, who gets paid back first? The mortgage company. Then you as the owner gets paid back second. So just be aware that there's usually a pecking order on some of these deals where they might say, no, you have a debt position. Now that might sound bad that you have a debt position versus equity position, because everybody in the world tells you equity is the way to go. But so you know, equity investors get paid lower on the pecking order. They get paid later than the debt fund people. So just understand that if you're in a debt position, that's not necessarily a bad thing. Although debt sounds bad, it could actually be good if you want safety of your money too. Again, no guarantees. There's nothing like that that's ever guaranteed. But the nice thing with alternative investments is you can make so much more money. And here's the coolest part, guys, is that when Wall Street tells you to do one thing, you feel like kind of stuck in a box. Like with one of our clients, Dan, that's what he felt like. He had $1 million in his retirement account, and the financial advisor said, you should only pull out $30,000 a year, the 3% rule, right? The new 3% rule, $30,000 a year. But when he heard our podcast, the Money Ripples podcast, which is another YouTube channel we have, he heard that. He said, my goodness, I can make way more money. He started doing different investments, diversified a little bit, and then next thing you know, he's making over $100,000 a year with that same money without touching his $1 million. So that's just from interest, guys. That way different income than $30,000 a year. Wouldn't you agree? And so that's the cool thing with these kind of funds, is that you can actually have some diversification and a little bit of safety and potentially better returns than you might get in the simple Wall Street main funds that you're always told to do by your financial advisor. And the reason they won't tell you to do alternative investment funds, because they don't get paid to tell you to do so. That's why. Now, if you want to know what kind of options you have, be sure to like and subscribe on this channel, because we've got way more information about the different types of investments you could actually be doing right now.